This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Patrick, I want to move on to our post-game chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have the Research Roundup email, it means you're not yet registered. Just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads. Patrick, chart deck says Update on the bond markets. Let's dive into it.
Yeah, well, I just wanted to quickly talk the charts on equity and crude oil before we get into the bond markets. But what I wanted to just touch on in the S&P 500, so we basically had a 300 S&P point whip from the intraday low to the high as we saw a meaningful rally. And the question is that enough to make it a bottom? And there's that old adage on there that the rallies in the middle of bear markets are often the most violent. And I'm not trying to call this a bear market, but it's simply pointing out that the magnitude of the rally to the upside has been directly proportional to the speed of which the stock market declined throughout January. So we've now approached a 50 to 61% retracement of the entire drop. And we're now entering a phase where we're going to find out whether this was exactly what that is, a bounce, and the market has more downside to come, or is the bottom actually in? And I don't know if I want to stick my neck out and make too bold of a call, but right now what we really want to see is as we sell today and go into maybe some selling tomorrow, will the buyers hold the line and buy the dip? If we see that the selling accelerates and we see that a new sell cycle has begun, we could easily be finding ourselves double bottom testing the 4,200 level, or even a breakdown to 4,000 could be in store. So it'll be a really interesting next week to watch. One of the things on page 3, when we look at that volatility index that we were highlighting, was a lot of that violent rally comes from the volatility contracting, or what's known as the Vanna influence on dealers. And what we saw was a collapse in volatility where we were as high as the 38 level the other week and find ourselves all the way back down toward the 20 handle during the collapse of volatility. And that really contributed to slingshotting the stock market higher. But the question is that now fully out of the market, and is now volatility going to return later this week or into next week? And it's certainly something on my mind.
Well, Patrick, I agree. And the thing that I would say here is do not assume that just because we've had so many retraces to all-time highs against all odds, it would seem, that it has to happen again this time. It really does feel to me like we finally have a little bit of this time it's different, in the sense that the Fed, regardless of whether they're really going to stay the course or not, at least for a while, they have to. And I think there's room for this market to be dragged further down. In any event, let's move on to page 4 with crude oil futures. What's going on there?
Well, we obviously had a pop toward $90 on the OPEC news, and it quickly market receded off of the initial positive reaction, putting in a doji candle, which is an indecision candle. And the one thing that I continue to highlight is that irrespective of my bigger picture bullish tilt on oil that could go higher, I continue to be of the position that this is way overdone on the short term. And I'll show some different stuff on the energy markets in a moment. But I'm wondering whether the OPEC becomes a short-term swing high. At some stage, a $5 pullback in crude oil or more toward $80 would be an incredibly natural pullback. And we'll certainly see whether in the coming days, whether this is where the market turns or whether the bigger, more prevailing bull trend just keeps trucking along. What's your take on the oil markets here?
Well, Patrick, normally I would agree with everything that you just said, which is to say we've had such a huge run up, we're way overdue for a $5 or even bigger, maybe $5 to $10 pullback. The thing is that there's still really tight physical market in Cushing, Oklahoma. I'm looking at the explosion today of the March to April time spread on WTI, back up at $1.85, almost $2 for 1 month worth of backwardation. That's really extreme backwardation, and it indicates tight supply. So on one hand, this market's way overdone, and if something changes, there's plenty of room for a really big pullback. The thing is, so far, nothing's changed, and what we've got is a really tight market. We've got the escalating situation in Ukraine and so forth, or perhaps it's de-escalating for the moment, but I think it's got more escalation ahead of it. And just as we're speaking, actually, ironically, as you were saying the words that the market tested almost $90 the other day on OPEC, we actually traded through $90, looking at 90.20 as we're speaking right now. So it looks like a break higher after that indecision candle may already be upon us. And again, I think we can get a couple more dollars up here, 92, 93 maybe. At some point, there has to be a big pullback, but not until this tight physical market gets resolved.
That makes sense. It's interesting to observe what's actually also happening in the energy sector ETF, or generally the basket of energy stocks. During this entire market pullback, they have been one of the few sectors that continues to work. Every pullback is almost immediately slingshotted higher, and everyone is grabbing at and chasing the energy plays to the upside. What is interesting is if we go to page 6, where I have the energy sector bullish percentage index, which is measuring how many of the energy stocks are in bull trend, we just hit 100%. And what is interesting is that over the course of the last 2 years, we've seen the energy sector hit this 100% mark on 5 occasions. And on each of those occasions, a market correction did ensue at some point. So while I do agree with you that there is still a tight oil market, and that certainly can drive short-term strength in this trend that is just so dominant, but there is probably not much asymmetry in grabbing at this. Look, if you've been in the energy market for the last few months, congratulations, you made some great money, but this is the wrong time to chase, in my opinion.
I would definitely agree with that, and there's plenty of potential here for this to go either really hard up some more or reverse down hard. And I agree for that reason. You don't want to be chasing it with new longs here.
Oh, you know what? Maybe we should straddle it up a little bit, eh? Anyway, so I want to touch on the euro, and particularly what's happening in the bond markets. On page 7, last week we were highlighting the breakdown in the euro, but after a little bit of a bounce, the ECB press conference and release just slingshotted the euro higher, and so while we've seen that dollar index weakening, it really has been a euro story. While the currency has made a meaningful break, what is more interesting is what has happened to the German government bond yields, the 10-year one on page 8. And for the first time in what was almost 3 years, we suddenly have seen a positive yield on 10-year government bond yields in Germany. We've crossed the zero line, and I think it's pretty significant because we've spent so long in negative interest rate territory there. I'm curious whether or not this is a sustained new trend, and whether this kind of bond bearishness continues in the bigger picture.
I'd love to get Jim Bianco's reaction to this chart, because you're exactly right, Patrick. We would have told ourselves that negative sovereign yields, especially on a major industrial country like Germany, were impossible just a few years ago. And of course, we've proven the impossible possible. Is that era of history over, or is this just a little blip and we're going back to that? Going to be very interesting to find out.
Yeah, what I want to move on to here is just take a walk through some of the different parts of the bond market. Here I have the TIPS Bond ETF, and what is interesting is that this has been a very weak part of the market. A lot of people have been grabbing at TIPS throughout much of the last year or two to get some inflation hedge into their portfolios, but really it's now given back almost all of its 2021 move. Obviously, you carried a yield during that period, but at least from a price perspective, we find ourselves back down to the March 2021 lows, almost like it's just really interesting to see that the tips have been this very weak.
Patrick, on page 10, we've got the ProShares Inflation Expectations ETF. Let's explain what expectations means and how that fits into this ETF and what it does.
Well, it's basically a call on what the market is pricing 30-year, in this particular case, 30-year inflation expectations of what is going to be inflation moving forward, not just what it is today. And what we continue to see is that the marketplace simply is not worried about secular inflation. And what we continue to see is that we're now trading at close to like 9-10 month lows, or at least testing the supports of those 9-10 month lows on inflation expectations here. And it's just really interesting to see that with crude oil ripping higher the way it is, and inflation printing as high as it is, this is simply not manifesting in these longer term expectations. Eric, so if I want to move on, though, when we look on page 11, I wanted to highlight just how weak global bond markets have been, right? I mean, we spend so much time staring at what's been happening on that 10-year U.S. Treasury yield. But when we look at the emerging markets bond ETF, and this is the emerging market bonds that are priced in U.S. dollars, just have been in a sustained downtrend. And their continued weakness, every rally is failing, just continue to deteriorate. And so while we certainly are highlighting that the bond markets in the U.S. are under stress, it is really a very broad story. And a lot of the world bond markets remain incredibly weak in this period. And in fact, I would almost argue that in many ways, U.S. bonds are not remotely as bad as some of these emerging market ones.
Patrick, let's move on to investment-grade corporate bonds on page 12.
Well, you know what? I just also wanted to highlight just that finally we are seeing the credit spread starting to blow out on these investment grade bond weakness that we've seen. So we have seen both in junk and in IG bonds a downtrend, but the downtrend was very much being driven by the entire interest rate complex rising and subsequently all bonds weakening. But we were waiting to see when the credit spreads, nonetheless, on these corporate bonds would start to rise, to start to show that there might be stresses in the space. And what's interesting here is while I don't have the junk bond one here, the corporate investment grade credit spreads have actually now broken to a year high. And it'll be really interesting to see whether this starts a new trend, because usually when these things start to blow out, they really start to run on the upside. Are we seeing the cracks in the corporate bond market here? It's going to be really interesting to see.
Listeners, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. Information is on page 14 and 15 or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.